Thank you very much, and thank you for joining us once again today. Mahar here, and we'll be discussing deferred tax assets today. And due to the Ramzan, we'll try to keep our webinar. Due to Ramzan, we'll try to keep our webinar very limited and very short. Moreover, and Ms. Faiza, she has not joined us today, and we'll try that she would be joining us in the coming webinars. So whatever we are discussing, straightforward, we'll discuss what is deferred tax at the very high level, then deferred tax assets. Till now, we have conducted 50 webinars, and this is our 50th webinar, 50 webinar that we have already conducted. And last webinar was on the deferred tax. In our last webinar, we have discussed that the accounting profits are different from the taxable profits, and this difference from the accounting profit, taxable profit, it can be a permanent nature. This difference can be a temporary nature as well. If the difference is the permanent nature, it will not have any impact in more than one tax period. But if the difference is of temporary nature, it will have an impact in more than one tax period. So if the impact is more than one tax period, the overall impact of the item will be same, but on temporary basis, might be this year my taxable profits are higher, future taxable profits are lower. There is a possibility that the current year taxable profits are lower, futures are higher, current taxable profits are higher, futures are lower, whatever is the case. So this was due to temporary differences. The permanent differences that we discussed, these permanent differences, we discussed the examples of permanent differences of fines and penalties. Like fines and penalties, these are not acceptable by tax authorities as an expense, but accounting standards, accounting practices, they allow to claim as an expense. So it will rise taxable, it will lead to differences, and these differences will be permanent differences. It will impact on one tax period. It will not have any impact in the future tax period. Some common examples that were discussed, like dividend, it was capital gains, fines, penalties. As we discussed, these are the items that are creating permanent differences, and it will have any impact in one tax period. Now discuss the temporary differences. Temporary differences, we said these type of differences, it will impact in more than one tax period. Overall impact of the amount will be same, but timing will be different. This timing difference can lead to deductible temporary differences. These timing differences can lead to taxable temporary differences. If the difference is sorry, if the difference is deductible temporary difference, it will lead to deferred tax asset. If the difference is taxable temporary difference, it will lead to deferred tax liabilities. So deferred tax asset, we have already discussed that these are the tax that the benefits will be given to the company in the future. This is the reason that we are booking the deferred tax assets today. And in case we are paying the lesser tax today and we will be liable to pay more tax in the future, then it lead to deferred tax liabilities, means our liabilities has been deferred over the period of time. One common example we discuss is depreciation. Sorry for this. One common example we discuss is a depreciation. This depreciation, the pattern of allocation for the depreciation is different. Might be tax authorities are allocating or depreciating the asset over the period of 5 years, and accounting authorities allocating or depreciating the assets over the period of 10 years. Timing differences will be there. So as I discussed, taxable temporary differences. These taxable temporary differences lead to deferred tax liabilities, and deductible temporary differences lead to deferred tax assets. Now, now we are going to discuss this deferred tax liabilities and deferred tax asset. Before going into the lecture for the deferred tax asset, we have already discussed this diagram. We discussed that accounting profit are different from the my taxable profit. This difference can be a permanent nature. This difference can be of temp nature. If this difference between the accounting profits and taxable profit is of permanent nature, then in one tax period, it will not have any impact in the future tax period. Since it will not have any impact in the future tax period, so this is my permanent differences. It will not lead to deferred tax, not lead to deferred tax asset. It will not lead to deferred tax liabilities as well. So example we discussed was dividend, capital gain, fines and penalty. Then the temporary differences. Temporary differences incurred in one tax period and will be offset in the future period or periods. It can be a two types. It can be deductible temporary differences. It can be taxable temporary differences. In case of deductible temporary differences, companies are paying more tax in the current tax period. They will be liable to pay lesser tax in the future tax period. So they have a right to book an asset. So deductible temporary difference will lead to deferred tax assets. And our examples discuss bad debts provision. We'll discuss in detail today. Then we discuss taxable temporary differences where my taxable profits are lower than accounting profit is items leading to lower taxable profit in the current tax period, and companies will be liable to pay more tax in the future. This is the reason they are booking deferred tax liability. The classical example is the prepayments. So this is the summary of our previous webinar. Now we are discussing deferred tax assets. Specifically, we know this why the deferred tax arises. We basically these are temporary differences in between my accounting profits and taxable profits. It's a temporary differences in my accounting item, the carrying amount and tax base. This temporary difference in carrying amount and tax base, we already discussed. Carrying amount is the amount that has been ascertained as per the accounting principles, and this is called my carrying amount. Tax base is the base as per the assigned by the taxation authorities. The difference between accounting profit, the difference between carrying amount and the difference between carrying amount and tax base, the difference between these two items will lead to, as I mentioned, it can be temp nature, permanent nature. Temp nature can be further classified deductible or taxable. So what the standards IAS 12 says regarding the deferred tax and deferred tax assets? First, they are asking deferred tax are the amounts of income taxes that are recoverable in the future that we have already discussed. This is the exact wording of the standard. They are asking deferred tax are the amount of income taxes that are recoverable in the future. Means might be we are paying now more tax, might be we given any benefit in the future. Due to this, we'll be able to recover the future tax. And this arises due to deductible temporary differences that we discussed. This arises due to carry forward tax losses that would arise from the tax credits. There are three areas that lead to deferred tax assets. It can be deductible temporary differences. It can be unused tax credits or tax losses. The reason is whenever these items will be there, the company will be liable to pay lesser tax and the company will recover these taxes in the future. Due to this, we are booking asset today. The para 24 of the IAS 24 says a deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable that taxable profits will be available against which the deductible temporary differences can be utilized. The important thing, now the deductible temporary differences are there. These differences can be, because as I discussed, due to the basically tax base is different, accounting base is different. My current period taxable profits are higher, deductible temporary difference. Or there is a possibility, there is a tax losses, these losses will be carried forward. There is a tax credit, these tax credits will be carried forward. Now the standard said you need to book the deferred tax asset. Once this deferred tax asset will be booked, after the booking of the deferred tax asset, but before this, you need to make sure that you will have a future taxable profits against these asset will be adjusted. If you don't have the future taxable profit, then these assets will not be adjusted. You cannot book the deferred tax asset. This is the primary and important condition to book the deferred tax asset. So I have summarized this wording of the standard into a summary format. What is the deferred tax asset? Taxes that would be recoverable in the future. This is the exact wording of the standard. Taxes that are recoverable in the future. These taxes arise by to carry forward unused tax losses, carry forward unused tax losses, carry forward unused tax credits, deductible temporary differences. These deductible temporary differences, there is a possibility my taxable income is higher or my taxable expense is lower. Both of these items, even my taxable income is higher or my taxable expense is lower, both of these items will lead to higher taxable profits. Means we will be liable to pay more tax in the current tax period. We'll be paying lesser tax in the future tax period. So this will lead to deductible temporal differences. So this higher taxable income or lower taxable expense, we'll look into the various examples for this as well. So, and as I discussed, the condition, important condition for to book the deferred tax is an asset is you need to make sure that you will have a future taxable profits against which these future taxable profit will generate tax liability. If you have a profit in the future, those profits in the future will lead to tax liability. Once the tax liability in there, this taxable asset again will be adjusted against that liability and remaining amount we will be required to pay. So if the future taxable profits we will have, we will be able to, it will be able to generate the tax liability. So basically this deferred tax asset will be adjusted against the future tax liability. If we believe we will have the future tax liability, then we need to book the asset. Otherwise we should not book the deferred tax asset. So by profit and loss items, I have just crystallized into various sections like P&L items. What is the possibility? First possibility is my taxable revenue is equal to my accounting revenue. There is a possibility, yes, my taxable revenue is equal to my accounting revenue. Another possibility is there is a possibility my taxable expenses are equal to my accounting expenses. So taxable revenue is equal to accounting revenue. If this is the case, sorry, if taxable revenue is equal to accounting revenue, so this is the case, I bet it would have been the income. This is income. So if my taxable revenue is equal to my accounting revenue, it means deferred tax will not arise. If my taxable revenue is greater than my accounting revenue, if my taxable profits are greater than my accounting profits, then we'll be liable to more tax now, future tax later, and it will be to deferred tax asset. And the vice versa, in the same way, if my taxable expenses are lower than my accounting expenses, again, it will lead to deferred tax asset because it will lead to more taxable profit. I will be able to pay more tax, lesser tax in the future. So this is the exact in wording in the language of a common man. If common man is asking what is my deferred tax, I'll say generate accounting profit are different from my taxable profits. My accounting profits are higher. We are paying more tax now. We'll be paying lesser tax in the future. Due to the deductible temporary differences. These deductible temporary differences are leading toward the deferred tax asset. But what the standard says, standard are using some technical words. Standard is using the word carrying amount and tax base. Carrying amount is the cost less accumulated depreciation or amortization. This is my carrying amount. This is the value assigned as per the standard. Then there is a tax amount, tax base. The difference between carrying amount and tax base, it can be standard said it can be a permanent nature, temp nature. These temp nature differences can be deferred tax, can lead to deferred tax asset, or it can lead to deferred tax liabilities as well. So in the language, technical language of the standard, if my accounting value is equal to my tax value, so it will not lead to any differences. Once it will not lead to any differences, it will not lead to deferred tax. Second, if my accounting value carrying amount is greater than my tax value, basically tax base, if my carrying amount is greater than my tax base, it will lead to deferred tax liabilities. What is the reason for this? The reason is, as I mentioned, carrying amount is equal to cost less accumulated depreciation or amortization. Then this is my carrying amount. Assuming 100 is my cost, depreciation is 20, accumulated remaining is 80. And for the time being, I'm assuming this is my carrying value, and tax base I'm asking this is 100. If my carrying amount is less than my tax base, it will lead to deferred tax asset. If my carrying amount is greater than my tax base, it will lead to deferred tax liability. What is the reason? Means whenever my carrying amount is higher than my tax base, it means that some of the expenses that have not been booked in the accounting as per the applicable accounting standard, but it has been recognized by the tax authority. This is the reason that my carrying amount will be higher than my tax base. Just look into the pattern of allocation of depreciation. Assuming one asset is there, this asset tax authorities are allocating it 50%, 50%, and accounting authorities are asking over the period of 5 years. So current period depreciation will be lower, tax depreciation will be higher. Current period carrying amount will be lower. Sorry, current period carrying amount will be higher, tax base will be lower. It means you lead to deferred tax liability. In case I'm looking into this, just look into this. There is a possibility that the one asset is there. This asset 100 is the cost, 100 is the cost. It is being allocated by the tax authorities over the period of 2 years. So 50 in the first year. This is my tax base 50 by the end of the year. Now, if it is allocated by the tax authorities over the period of 5 years, it will be 20. So it will be 80. 80 is my carrying amount. 50 is my tax base. Here the carrying amount is greater than my tax rate. It will lead to deferred tax liability. Why? Because in the current period, my accounting profits are higher because the depreciation is lower. Lower depreciation means higher accounting profits. Higher depreciation will lead to lower taxable profits. Once my current period taxable profits are lower, it means I will be paying lesser tax in the current tax period. Then I will be paying more tax in the future tax period. So it will lead to deferred tax liabilities. In the same way, if my carrying amount of the asset is less than the tax value, it will lead to deferred tax asset. The same general principle, the reciprocal principle applicable on the liabilities as well. If my accounting value of the liability is greater than the tax value, it will lead to deferred tax asset. In the same way, if my accounting value of the liability, carrying amount of the liability is less than the tax value, it will lead to deferred tax liabilities. These are the technical language that has been used by the standard. And then crux is same. Accounting profits are taxable profits. If any of the item will not have any impact on my accounting profits or my taxable profits, it will not create any difference. Once it will not create any difference, it will not lead to any deferred taxes. So objective, the carrying amount tax base, it will have impact on the profit and loss account. It can be a permanent nature, it can be a temp nature. If temp nature, it will impact on the temp nature, it will lead to taxable temporary differences or deductible temporary differences. So these are the basically deductible temporary difference. We need to keep this principle in mind while calculating the deferred tax asset or deferred tax liabilities, carrying amount, tax base. The second thing, as the standard said, this is the tax losses. Tax losses, we know this as per the UE law, tax losses can be carried forward for unlimited period of time. If the tax losses are there and these are being carried forward for unlimited period of time, means this tax loss will reduce my taxable profits in the future and it will give me benefits. So I need to book the related assets under the prudence principle today itself, accrual principle. So whatever the benefit that I'll be getting from this tax loss in the future, I need to book it as an asset. In the same way, tax credit, if we are getting any benefit from the tax credits in the future, we need to book the deferred tax assets today itself. So these are the three different things that lead to deferred tax asset. Deductible temporary differences, carry forward or unused tax losses, carry forward or unused tax credit. These three things will lead to deferred tax assets. So these are the examples that I've taken from the standards. These are the items that lead to deferred tax assets. Retirement benefits. In the retirement benefit, if you are creating a provisions and this provision will not be accepted by the tax authorities. Once you are creating the provisions, means when you're creating the provision, you will be booking expenses, payable provision you are creating, your accounting profit will come down. There will be no change in the tax profits. Accounting profits are higher, taxable profits are higher, accounting profits are lower. Once my taxable profits are higher, means we need to pay higher tax in the current tax period. and this will lead to deferred tax asset. In the same way, accumulated depreciation, pattern of allocation different. If the pattern of allocation is such like this, my current tax period is higher than my future tax, or my current taxable profits are higher than my future taxable profit, then I need to book the deferred tax asset. In the cost of inventory sold, when the inventories are being sold before the end of the reporting period, then once the inventories are being sold, you need to do it for sure. You will deduct it from your profit and loss account. But once you are deducting the cost of inventory from your profit and loss account, your tax accounting profits will come down. But tax authority, they're asking, they will recognize the inventories once you will receive the cash for this. So for the time being, here, once the inventories are being sold, COGS, the impact on the COGS, accounting profit will come down. Tax profit is higher, accounting profits is low. Again, you will be paying higher tax in the current tax period. That will lead to deferred tax asset. NRV concept is inventory. Basically, NRV concept, you are booking the reducing the value of the inventory. Impact will go on the profit and loss account. Once impact will go on the profit and loss account, tax authorities will not accept it. So it will lead to higher taxable profits. Research and development cost. Research and development cost, whenever you are paying, organization startup costs are recognized as an expense and determine accounting profits. In the first tax period, once the research and development is there, in case of research and development, you are booking it as an expense. Tax authority, they will allow you whenever you will actually pay this. So you are amortizing, you are not till pay now. So you are amortizing, you are booking and amortizing over the period of time. Your tax expense is lower. Accounting profit, taxable profit will be here. It will lead to deferred tax assets as well. Income that is being deferred is one of the example that will lead to deferred tax asset. Financial assets, the investment property are carried at fair value. Change in fair value. This is one of the common things that we're discussing in the UE corporate tax law as well. Now, the law requires that the asset should be carried forward at the arm's length price while moving transitional provision, while moving from the non-tax period, the non-tax era to the tax era. My asset needs to be carried forward at the market value. Might be the value of the asset in the books is different. Now, property value in the books is different. Investment property value in the books is different. But whenever we are carrying it forward, tax law requires we need to mark it at the market value. Once we need to bring it at the market value, tax authorities, assuming the value is 100, as this is a 100, you can say accounting principle, tax say 120 or tax say 90 as well. So this difference will be a temporary difference, because this difference will be amortized. The difference will be over the period of time. The overall impact will be seen, because when this property will be sold, so whatever the gain or losses will be, it will be at the end, it will be subject to tax. So this temporary difference, it can lead to deferred tax asset. At the same time, it can lead to deferred tax liabilities as well. This is the one of the common example in the market that a lot of people are asking, that we need to book the deferred tax asset or deferred tax liability, whatever is the case, by valuation, change in the valuation of the property, change in value of the asset, because the value that is reflecting in my financial, that value is different, and law requires we need to bring it at the market value. Once we bring it at the market value, this market value will crystallize over the period of time. This will be temporary difference. We need to book the deferred tax as well. Some more example, the business combination is there. Changes in fair value, inter-group transaction, tax authorities are not accepting. We'll discuss all these things sometime in detail, but the core crux is your accounting carrying amount is different from the tax base. That is leading have an impact in your current tax period. Once it will have impact in the current tax period, it means you will be paying higher tax now, lesser tax later on, deferred tax asset it will arise. Just look into these examples. Some of the examples I have taken from the IAS 12. Some of the examples I have developed myself. Like IAS 12, an entity recognizes the liability of 100 for accrued project warranty cost. For a tax period, the product warranty cost will not be deductible until panel warranty will be paid. Again, this is a provision. An entity believe that 25% is some certain percentage they are booking liability as a warranty. They are selling the products. They believe they are giving the warranty. Against this warranty, they will be liable to pay certain types of payments. One, they will be liable to pay certain types of payment. They are booking their liability today itself. Once they are creating the provision for the expected warranty cost, They will be booking expenses, they will be passing the entry expenses, debit, payable, credit. Now this provision, it will not be accepted by the tax authorities. Just keep in mind, we're not discussing anything related to the FTA. We're just discussing deferred tax asset, just a generic standard, generic provisions. Usually tax authorities are not accepting provisions. Once they are not accepting provisions, it means my accounting profit will be lower than my taxable profits. Once accounting profit, why this is lower? Because here we have booked the provision as an expenses against the warranty. Here the tax authorities are not accepting. So once here, this is my tax base is 100, accounting is 80, assuming 20 are booked as an expenses 20. So this 100, my taxable profits are higher as compared to my accounting profit. We need to pay more tax now. It will lead to deferred tax asset. So tax base of the liability is nil. As with the tax, if you are typically asking in the language of the standard, carrying amount versus tax base. How much is the carrying amount? Carrying amount they are asking. The tax carrying amount is assuming whatever the carrying amount 100, tax base 0. So the reason is this is a carrying amount for this expense, tax base is 0. This 100 will reduce the taxable profits, and my current period, sorry, this 100 will reduce my accounting profits, but tax will not recognize it. My taxable profits will be higher. The same thing they have given in the example as well. So going back to the basic principle, whatever we have discussed here, we said if my accounting value is greater than my tax, this one, if my accounting value is greater than my tax base, my tax will lead to deferred tax liability. And for the expenses, we said if the expenses, taxable expenses are lower than my accounting expenses, then it will lead to deferred tax asset. So this is the one of the example. Then second is tax authority may require business to pay tax on a greater amount of income compared to what is reported in the income statement, resulting in a higher taxable profits. If a business receives 3 years rental amounting to 300,000 as an advance, business has received in advance 300,000 as a rental. Now, once the business is receiving, usually tax authorities are following cash basis of accounting, and accounting principles say amortize over the period of time. So accounting authorities are amortizing over the period of 3 years. Tax authorities are asked, no, you need to book an income in the same tax year. My carrying amount is in the current period is 100. Tax base is 300,000. So this is my rental income. This rental income 300,000, this 100,000 as this is means higher taxable income, higher taxable profit. It will lead to deferred tax asset. Because however, the tax authority operate on a cash basis and calculate maintain the entire 300,000 rental should be treated as taxable revenue in the initial period. Once this is being treated taxable revenue 300,000 in the current tax period, my taxable profit will be higher as compared to my accounting profit. It will lead to deferred tax asset. Another example is taxable expenses below accounting expenses. Common example like provision, warranty I have discussed. Companies often record expenses and the estimates and provision. This is the same example almost that were discussed. Let's take a company such as X Limited. They project using historical data. 5% of their total sales equivalent to 1 million should be set aside for repair in the next year to cover potential warranty claims. So they are creating a provision 5% of the 1 million. They are creating a provision. As a result, X Limited create a provision of 50,000, which may not be accepted by tax authorities. This provision is an expense. This expense will be booked by as per the accounting principle, but this expense will not be accepted by tax authorities. Once it will not be accepted by tax authorities, again, my accounting profits will be lower from my taxable profit by 50,000. That will lead to deferred tax asset. One more example is there. CX Limited incur a tax deductible loss of 100,000 for 1 year. This is the loss. We discuss three things: deductible temporary differences, carry forward losses, or carry forward tax credit. Now they're asking in the year one, company has incurred a loss. The loss is 100,000. Tax is 9%. Now the company believe that the company will have taxable profits in the future. So if the company believe that the company will have taxable profits in the future, company can book deferred tax asset related to this tax loss or unused loss. So company has booked a deferred tax asset. As a result, company has a deferred tax of 9,000. Tax loss is 100,000 into 9%. 9,000 is my deferred tax asset. In the year two, company generated taxable revenue of 150,000. 150,000 is my taxable revenue. 9% of 150,000 is 313,500. This is my tax payable in the year two. But the company will be able to adjust this 9,000 that they've already booked the deferred tax asset, because we've already discussed if the benefits of the tax will be given to the company in the future, it will reduce the tax obligation of the company, subject to the condition company must have the probable taxable profits. So company has the taxable profit. Here they book the deferred tax asset debit to taxable income credit. Here they have booked it like this. Here they generate deferred tax liability. Sorry, this is the taxable profit. It will to tax liability, and out of this tax liability, 9,000 for the previous period will be adjusted. Remaining will be payable to the tax authority. So this is the examples of carry forward or unused tax losses. You can see that whatever the tax loss in the year one, the benefit of this tax loss has been given to the company in the year two, because the company believe in year one that they will have the taxable profits in the future. The company have taxable profit in the year two. This 9,000 has been adjusted, benefit has been given to the company in year two, which has reduced the tax liability of the company. For tax credit, example is almost same, the pattern is almost same. Research and development, you can say 200,000 in year one, but the research and development, the tax authorities are given provision that they can take a credit for this. So 200,000 is my research and development tax credit. 200,000 into 9%. Again, this amount, it will be 200,000, 18,000. The company can take this benefit of tax in the future, because tax authorities allow that you can, if you're investing, if you're doing any research and benefits, tax benefits will be given to you, tax credits will be given to you. In the year two, company generated income of 300,000. The 9% of 300,000 is 27,000. How much benefit will be given to the company? It will be 200,000 into 9%. 18,000 benefit will be given. Company will be able to pay 9,000 of tax in year two. So discuss three things. First, we will discuss in the deferred tax. First, we discuss deductible temporary differences. We have gone through the various examples that lead to deductible temporary differences, where my taxable profits are higher, accounting profits are lower, and we will be paying more tax in the current tax period, lesser tax in the future due to this deductible temporary difference. We have gone through the various examples. This was the one scenario. Second was basically carry forward or unused tax losses, that the benefit of the carry forward unused tax losses will be given to the company in the future, that was seen in the previous example. We need to book the deferred tax asset. Third thing is the tax credits as well. Due to this tax credit, company will be liable to pay lesser tax in the future. So company needs to take the benefit for this, and company will be paying lesser tax in the future. So we need to book the deferred tax asset today. This is the one more example. I have taken it from the standard. We have one classical example. The entity A purchases 1,000 at the beginning of year a debt instrument. What was the cost of the debt instrument? It was 100,000. It was only 1,000. Instrument with the nominal value of 1,000. Just keep in mind, what was the nominal value? Nominal value is 1,000. Company has bought the nominal value, the debt instrument of 100,000. So carrying amount and tax base is same at the beginning of year one. Carrying amount and same. Whatever the value assigned as per the accounting principle, and whatever the value assigned as per the tax principle, this is same on 1st of Jan 2000. So whatever is on first at the beginning of year one. The life of the debt instrument is 5 years with an interest rate of 2%. Payable at the end of each year. Interest is being paid in arrears. The effective interest rate is 2%. The debt instrument is measured at fair value. So debt instrument fair value 2% in the interest rate. Current market value is 1,000. The company has bought it 1,000 at the beginning of year one. At the end of year two, the fair value of the debt instrument is has decreased. Fair value has decreased. We know this, that fair value is inversely proportional to the interest rate, market rate. Higher will be the market rate, lower will be the fair value. Lower will be the market rate, higher will be the fair value, because this rate is itself cost. This rate itself cost of the debt instrument. Cost is 2%. If the cost is lower, value will be higher. If the cost is higher, value will be lower. This is always inversely proportional. So initially, when 2% was the interest rate, market value was 1000. Now they're asking the interest rate is 5%. Once the rate has gone up, market value has come down, it has become 918. 918 is the market value. 918 is the value as per the applicable accounting standards. So carrying amount is how much? Carrying amount versus tax base. Carrying amount is 918. Tax base is 1000. We have already discussed where the carrying amount of the asset is greater than the tax base, it will lead to deferred tax liability. Where the carrying amount of the asset is lesser than the tax base, it will lead to deferred tax asset. Deferred tax asset. Here, this is the carrying amount. This is a tax base. Carrying amount is lesser than the tax base, it will lead to deferred tax asset. The same thing they have given in the example as well. According to the tax base of debt instrument original cost, the difference between the carrying amount of the debt instrument in equity A statement of financial position 918 tax basis 1000. This is what we have discussed. 918 carrying amount tax basis 1000. It will lead to deductible temporary differences. And these deductible temporary differences will lead to deferred tax asset. Deductible temporary differences of 82. Hey, how much the deductible temporary differences? These are my deductible temporary differences. 82. Because accounting principle say the value of the asset is 918. Tax principle says value of the asset is 1000. And the company, due to this, company will be paying more tax, lesser tax in the future, more tax in the current tax period. So this will lead to deferred tax asset. And then they have given that this is because deductible temporary difference, the difference between the carrying amount of asset and liability in the future proposition tax base will result in amount that are deductible and determine taxable profits. When the carrying amount of asset liability is recovered or settled, entity obtains the deduction equivalent to tax base of an asset once determine the taxable base, either on sale or on maturity. So whatever the case, benefits will be given to the company in the future when it will be realized. So company will be paying more tax now, lesser tax in the future. At the end, it will lead to deferred tax asset. So this is over from our side. Thank you very much. If you have any specific question, I'm happy to address. Natural person having less than 1 million sales is not supposed to register for CAT, right? Yes. In this situation, natural person will never register for CAT, or there is a limit for the period. Hasib is asking this question. The natural person, if the natural person is doing any business, naturally there are two possibilities. Natural person like individual is doing any business, or individual is not doing any business. If the individual is not doing any business, they are not subject to corporate tax, because this is a corporate tax. This is applicable on the corporation. This is not a personal income tax. So it will not be subject, individual natural person will not be subject to corporate tax. But if the natural person is doing any business, once the natural person is doing any business and from the business income, their revenue in the Gregorian calendar year is up to 1 million, then the natural person, whoever is doing, they are not liable to register for corporate tax, and corporate tax will not be applicable to them. Just keep in mind, when this 1 million is being calculated, revenue from all businesses will be considered. First thing. Second important thing is, if you have any asset in the business and you are selling that asset, the revenue sale proceed from that asset will be considered to ascertain 1 million as well. This is the basic catch here. So suppose you are doing sole establishment, you are doing one business, revenue less than 1 million. There is one asset in the business. You are suppose furniture, suppose laptop, suppose any other equipment in the business that you are selling. The sale proceed from that equipment, from that asset, will be considered to ascertain the to check whether the threshold of 1 million has been crossed or not. The two important things are there. First, from sale proceed from all businesses in the Gregorian calendar year. Second, sale proceed from the asset will be considered as well to ascertain the revenue of 1 million. So any other question? No more question. Thank you very much, guys. So I think I was not able to speak properly today, and apologies for this. Stay in touch. I will keep discussing corporate tax. If you have any question, you can drop us email. You can give us a call as well. Thank you very much and have a lovely evening. Thank you. Bye bye.